Go find a Bible. Doesn't matter if it's on your phone, on your shelf, dusty in a drawer somewhere. Open it to Ecclesiastes 11. Read the first 6 verses. I'll wait. Now tell me what you just read. Most people say something like, "Oh, it's about being generous," or "It's about trusting God," or it's some kind of farming metaphor about seeds. Here's what you actually just read. A diversification strategy, a risk-adjusted allocation model, a behavioral framework for investing under uncertainty, written approximately 2,500 years before Harry Markowitz published Modern Portfolio Theory and won the Nobel Prize in Economics for it in 1990. That's not a metaphor. That's a portfolio manual. And today I want to show you exactly how it works. Because once you see the financial logic inside these 6 verses, you will never read this chapter the same way again. Let's start where we have to start, the text itself. Ecclesiastes 11:1. Cast your bread upon the waters, for you will find it after many days. Every commentary you've ever read tells you this is about generosity. Be charitable, give freely, what comes around goes around. That reading isn't wrong, but it's incomplete, because in the commercial world of ancient Israel and the broader Near East, this verse describes a specific, documented financial practice: bread upon the waters. In the ancient Mediterranean economy, grain merchants would load cargo ships with grain, their bread, and send them out across sea trade routes to distant markets. Alexandria, Cyprus, Carthage. The investment was real, the risk was real, and the return, when the ship came back, was real. And the Hebrew phrase used here, shalach lachmecha al penei hamayim, is maritime commercial language. Josephus, writing in Antiquities of the Jews, documents the grain shipping networks of this era in precise detail. Ships loaded with thousands of talents of grain, dispatched across routes where storms, pirates, and market fluctuations all pose genuine loss risk. So verse 1, translated through its actual economic context, deploy capital into trade, accept the risk, expect a return. That's not charity. That's venture capital. Now verse 2, give a portion to 7, or even to 8, for you know not what disaster may come upon the land. 7 portions, or 8, not 1, not 2, 7 or 8 distinct allocations of your capital across different positions. And think about what that number meant in an ancient economy with no stock exchange, no index funds, no diversified ETF products. 7 or 8 meant 7 or 8 separate trade caravans, 7 or 8 distinct merchant partnerships, 7 or 8 commodity categories: grain, oil, wine, spices, textiles, metals, livestock, timber. The allocation was deliberate. The logic was explicit, because you do not know what disaster may come. That phrase is load-bearing. You know not what disaster may come. This is not pessimism. This is the foundational assumption of every risk management framework ever built. Uncertainty is the condition. Diversification is the rational response to that condition. Markowitz called it variance reduction across a portfolio. Koheleth called it giving a portion to 7 or 8. Same idea. One of them has a Nobel Prize. The other was writing before Athens had a democracy. Verse 3. If clouds are full of rain, they empty themselves on the earth, and if a tree falls to the south or to the north, in the place where the tree falls, there it will lie. This is the chapter's acknowledgement of macro forces. Weather happens, events happen, a falling tree cannot be argued with. The ancient investor understood something that modern behavioral economics has spent decades documenting. There are market conditions outside your control, and the psychologically healthy response to them is neither panic nor denial. It is the recognition that the system will operate whether you approve of it or not. Clouds full of rain will rain. You plan around it. You don't stop farming. Verse 4. Whoever watches the wind will not sow, and whoever looks at the clouds will not reap. This is the behavioral finance section of Ecclesiastes. Whoever watches the wind will not sow. Whoever waits for the perfect entry point, the perfectly quiet market, the moment when all indicators align, they will never enter. They will watch the market from the sideline, paralyzed by conditions that never achieve the perfection they require. This is analysis paralysis, documented 2,500 years before the term existed. The person staring at the wind is the person who spent the 1990s waiting for the dot-com bubble to be obviously a bubble, who spent 2010 waiting for the recovery to be obviously real before buying back in, who spent 2020 waiting to see if the pandemic rebound was sustainable. They watched the wind. They didn't sow. Verses 5 and 6. As you do not know the way the Spirit works, or how bones grow in the womb of a woman with child, so you do not know the work of God who makes everything. In the morning sow your seed, and at evening do not withhold your hand, for you do not know which will prosper, this or that, or whether both will be good. There it is. In 2 verses, Koheleth has constructed what a modern financial advisor would call a time diversification strategy combined with dollar-cost averaging. Sow in the morning. Do not withhold your hand at evening. You do not know which will prosper, so you invest at both times. You spread not just across categories, but across time. You remove the pressure of timing the market perfectly by making timing irrelevant. Morning and evening. Consistent allocation across time intervals. You do not know which will prosper, this or that, so you make sure you have exposure to both. That's not a spiritual suggestion, that's a deployment schedule. Now let's go to the modern side, and let's be precise about the timeline, because the timeline is the argument. Harry Markowitz published Portfolio Selection in the Journal of Finance in 1952. It introduces modern portfolio theory, the mathematical case for diversification across non-correlated assets. The core claim: you can reduce portfolio risk without proportionally reducing expected return by holding multiple positions whose performance does not move in lockstep. The more positions, the more the idiosyncratic risk of any single investment gets canceled out across the whole. Markowitz wins the Nobel Prize in 1990. The concept enters mainstream financial advice. By the 2000s, it is the foundational framework of every target date retirement fund, every robo-advisor, every piece of advice that says, don't put all your eggs in one basket. Don't put all your eggs in one basket. The folksy translation of a Nobel-winning mathematical framework. Meanwhile, the most practical advice retail investors receive today runs roughly as follows. Hold a diversified portfolio of index funds across multiple asset classes. Invest consistently regardless of market conditions, the strategy known as dollar-cost averaging. Resist the urge to time the market. Maintain your investment discipline through volatility. Extend your time horizon. These are the 5 pillars of modern passive investment advice. They are what Vanguard built its business on. They are what Warren Buffett recommends to the vast majority of investors who are not full-time capital allocators. Run the numbers against the S&P 500 and the data is clear. The investor who enters the market consistently, holds diversified positions, ignores short-term volatility, and maintains a long-time horizon outperforms the vast majority of active traders over any 20-year window. DALBAR's annual quantitative analysis of investor behavior has tracked this gap for 30 years. The average equity fund investor consistently underperforms the index they're invested in. Not because the index fails, but because the investor times it wrong. They watch the wind. They don't sow. Here is where it gets precise, and this is what I want you to hold on to. Ecclesiastes 11:2 says, "Give a portion to 7 or 8." Modern portfolio theory says hold a minimum of 15 to 20 uncorrelated positions to approach maximum diversification benefit. 7 or 8 in a pre-industrial economy of discrete merchant ventures may have represented maximum practical diversification. You could not easily hold 20 separate trade caravans with finite capital and finite oversight capacity. 7 or 8 was the ancient investor's functional equivalent of a diversified index. Same logic, different ceilings. Ecclesiastes 11:4 says the one who watches the wind will not sow. DALBAR's 2023 report found that the average equity investor earned 6.81% over the 20 years ending December 2022. The S&P 500 returned 9.80% over the same period. That 3 percentage point gap, compounded over 20 years on a $100,000 starting investment, is the difference between $379,000 and $645,000. And that gap exists almost entirely because investors attempt to time entries and exits. They watch the wind. It costs them $266,000 on a $100,000 investment. Koheleth told them not to do this 2,500 years ago. Ecclesiastes 11:6 says, "Sow in the morning, and do not withhold your hand at evening." Dollar-cost averaging studies consistently show that investors who deploy capital on a fixed schedule, regardless of market conditions, outperform lump sum timers over rolling 10-year periods in approximately 67% of historical cases, according to Vanguard's own research published in 2012. Morning and evening. Fixed intervals. Let the timing be irrelevant. Ecclesiastes 11:3 says the cloud full of rain will rain. Accept macro forces as given. And the modern equivalent is the distinction between systematic risk, which cannot be diversified away, and unsystematic risk, which can. No amount of portfolio construction insulates you from a global recession. But a global recession does not destroy a diversified portfolio the way it destroys a concentrated one. The tree falls where it falls. You build the house somewhere the tree cannot reach. And Ecclesiastes 11:1. Cast your bread upon the waters, for you will find it after many days. Every long-term return study in financial history points to the same finding. Time in the market, not timing the market. The bread goes out, it comes back. The return is not immediate. Many days, sometimes many years. But the compounding mechanism that makes long-term investing work requires the initial deployment. The bread actually cast. The ship actually sent. Here's what nobody asks about this passage. If Solomon, the figure most scholars associate with Koheleth's authorship, or at minimum with the wisdom tradition Ecclesiastes represents, had access to a modern brokerage account, what would his portfolio look like? It would look like a diversified index fund held on a consistent contribution schedule with a long time horizon and no market timing behavior. That's not a religious claim. That's a structural one. The framework inside 6 verses of ancient Hebrew wisdom literature is the same framework that modern financial science spent the second half of the 20th century deriving mathematically. So what do you do with this? First, stop reading Ecclesiastes 11 as a devotional passage about generosity and trust. It is that, but it is also a financial operating system, and the operating system is sound. It has been validated by 70 years of modern financial research. You do not need to take it on faith. You can run the math. Second, follow the money through the text. Give a portion to 7 or 8. That means diversification is not optional, and it is not modern. It is ancient wisdom that recognizes the fundamental condition of investing under uncertainty. You don't know what disaster may come. Nobody does. So you don't concentrate. Third, do not watch the wind. The behavioral trap Koheleth identifies in verse 4 is the most expensive mistake retail investors make, and it has a documented price tag. That price tag is north of $260,000 on a $100,000 investment over 20 years. The wisdom here is not sentimental. It is financial. Fourth, I sow in the morning and in the evening. Pick a schedule. Keep it. Make the timing irrelevant. The mechanism works because of consistency, not because of precision. And fifth, give the bread time to come back. Cast it. Send it. Then wait. The compounding that makes long-term investing extraordinary is not complicated, but it requires the patience to let many days pass. Here's what you're really looking at when you read Ecclesiastes 11. A document written in an era without stock markets, without index funds, without compound interest calculators, without Nobel-winning economists, that nonetheless arrived at the same behavioral and structural conclusions that modern financial science reached after a century of mathematical modeling. That's not a coincidence. That's what wisdom literature is for. Not to tell you what God wants you to feel, to tell you how the world actually works. Koheleth saw it clearly. The water will take the bread, the cloud will give the rain, the tree will fall where it falls, and the person who builds a portfolio around the reality of uncertainty, diversified, consistent, patient, unafraid of the wind, will find it after many days. Do the math. The ancient world already did. If you want to keep seeing the financial systems inside Scripture the way a strategist reads them, rather than the way a sermon delivers them, the channel is here. Every video is built on the same question. How did this actually work? Subscribe if that question interests you. Share this one if someone you know is still watching the wind.